S.D. Bullion.
This is the Doc with SilverDoctors.com. We're pleased to welcome silver analyst David Morgan from SilverInvestor.com today. Thanks for joining us, David.
My pleasure, thank you.
I wanted to start off today, David, just with some questions. I wondered what your thoughts are on silver's current supply and demand. I kind of took a look last night, and after nearly a record-breaking January, Silver Eagles, as we know in February, dropped down to just under 1.5 million ounces sold in February, but they seem to starting to be rebounding here in March. It looks like March to date the mint has sold 2.14 million ounces month to date versus 2.77 million ounces sold in March 2011. So, kind of what are your thoughts about silver's current supply and demand?
Well, that could take up a long time, and I'll try to be succinct. But first of all, on the supply demand for silver, as we all know, that at least study the silver market rather carefully, that there's really two supply and demands. There's investment demand and industrial demand. I'll address industrial demand first. The industrial demand has been increasing rather significantly over the last decade or so. If you go back roughly a decade, you'll find that the total demand of silver on the industrial side was about 38% of the market. And if you look at the more recent studies, it's about 54% of the market. And during that 10-year time frame, the silver production from mining has gone up significantly, and that's primarily due to the commodities boom overall, and that's primarily been driven by China. So that means that, the demand side on industrial uses has increased. Now, where are we now, which is your question, is I think it's tapering off, and one of the big drivers for industrial demand the last few years has been solar panels. And they've been increasing. In fact, China's actually doubling the amount of solar panels that they've been producing in the last few years. That, I think, is going to slow down. And I'm not going to say much more on that other than I'm going to address it in the next issue of the Morgan Report, which will be the April issue coming out in a couple of weeks. I'm not going to go into great detail. You don't have to go into super detail to get the right ideas across. And actually, Kitco, one of my friends at Kitco, did a pretty good research on solar panel usage and production going out further in the next few years. So that, I think, is going to start to cool off. As far as the investment demand goes, I have to also look at the supply side first and then talk about the investment demand. On the supply side, as I mentioned earlier, it's increased from the year 2000 to present. And investment demand has been steadily increasing over time. If you go back and look at the supply demand from, say, 1990 to 2006, we're in a structural deficit, which isn't a shortage. A deficit means the amount of silver supply by both all demand, meaning industrial demand, investment demand, are greater than what's produced by mining activity and recycling. And that was about 100 million ounces a year for about 15 years. So roughly 1.5 billion ounces of silver were depleted from 1990 to 2006. And at that time, the production curve on silver actually crossed over the demand side, counting recycling. So there's now actually more supply than there is demand, and that's basis, not me saying it, that's basis both the studies from the Silver Institute and from CPM Group. I believe them to be true, and I think base that basically on what we have in the public domain, which is how much silver is out there on the investment side and a rough estimate of how much is used in the industry. So the low point in the total supply of silver was roughly 2006, and the supply at that time was probably 500 million ounces. And today we've probably got double that at least. And this is only in commercial bar form that I'm speaking about now. I'm talking about 1,000-ounce bars in that form only. We're at 500 million ounces 2006. Today we're probably at 1 billion ounces. The investment demand has increased steadily, especially from that point that I just mentioned, 2006. In April 2006, the SLV was started, the first major ETF for silver. At the inception, there was 130 million ounces of the offset. Now we're about triple that, not quite. We're about 300 million ounces plus in the SLV, purportedly the largest holding of physical silver in industrial form, in other words, in 1,000-ounce bars. The demand in all the ETFs holding companies, any entity that holds 1,000-ounce bars as an investment, has gone roughly from that point, April 2006 till now, to about 800 million ounces that we can see in the public domain. Now there's more than that because there's entities that hold it that don't report, and so you have to kind of make an educated guess. So the supply side has increased, but the demand side has increased. The demand side for the retail portion of the market, which is best looked at in the Silver Eagles or Silver Liberties as they're actually named, has been increasing substantially the last few years. When you go from the inception of the program of 1986 through about 3 years ago, the average amount of offtake was about 10 million ounces. Then a few years back, it doubled about 20 million ounces, and we go back last year, it was up 40 million ounces. And now we are seeing it probably wane off a bit. These markets are volatile, as we all know. And I think right now where we are is we're in a flat period. We're in a consolidation period. And I believe that a lot of people that are really savvy about the silver and gold story are in. In other words, they bought their silver over the last few years, or maybe perhaps 10 years ago, or at some point from the beginning of the bull market till now. They're in the market, and they really aren't in a position to add to their holdings. Or if they are, they're waiting for a pullback. And there aren't a lot of new buyers in the market right now on the retail side. On the professional side, the money managers, pension fund managers, hedge fund types, they're slowly coming back in the market. And what's interesting there is they're coming in the market primarily on the physical side of the market. Now, when I say physical side of the market, I mean truly the physical side of the market, which is buying like monster boxes or, again, commercial bars for investment. And also many of them use the ETFs because they're so convenient, and it's a proxy for holding physical silver. So bottom line, I'll sum it up by saying this. I think we still have a consolidation period ahead of us. We're doing this basically in late March 2012. I think we have several months, probably till September, October of this year, before really we break through this consolidation level and get silver up to the above $40 level or so. I could be wrong, obviously, and I'll state that. But I think a lot of the people that are in the silver market and the gold market, they pretty much track together. There's an 84% correlation between the two metals. So the argument that silver is a lot different than gold is erroneous. It isn't exactly like gold, but it's very, very close. Regardless, I think you're going to see more consolidation and more people that are in the mode, that kind of a phrase I coined saying the scare you out or wear you out mode. The scare you out mode is when you get these huge sell-offs like we saw on the 29th of February. In the silver market. That scares a lot of people, and people that are waiting on the sidelines for a pullback see that take place. And although a week before told themselves that if they ever saw a pullback like that, they'd jump in, they don't. They get scared and they don't get in the market, or they get worn out. They've been holding silver, let's say, above the $30 level. Let's say they're holding around 35, which is approximately where we are now. And they've watched it go to 48, and they've watched it come down to 26 and touch that very briefly, and they watch it come back and consolidate around the $30 level, $35 level, and they're worn out. They say, silver isn't as good a thing as I thought it was, and I've been holding it now for month after month after month. It doesn't seem to be going anywhere, and I've got this other opportunity. So they sell their silver, and they're out of the market, and they're probably correct for a few more months, and then, of course, once it starts to go back up and hits the $35, $40, $45, $50 level, then they wish they would have held. But that's how markets work. That's the psychology behind it. Obviously, I probably drilled that one down to further than you wanted, but you asked, and I can speak about the silver market if you give me the opportunity.
Okay, well, let's kind of piggyback on the beginning of your response there and talk about the supply side. With an invasion of Iran looking increasingly likely by the day, we've basically already began the attack financially by locking them out of the SWIFT system. How do you see spike in oil prices impacting the supply side of gold and silver? Like how long would oil need to stay elevated before we could potentially see an impact on the mining output?
No, great question. I don't know the exact answer, but your thinking is very correct. A lot of the silver is through base metal mining production. In fact, about 70%. And a lot of the bigger base metal mines that produce a great deal of the world's silver are open pit mines. Those mines are not that efficient. The only thing that makes them efficient is the fact that the prices for the metals are high enough and that fuel prices are low enough that the margin or the spread between the two economically makes it viable. Once you start increasing the cost to mine, these mines become uneconomic. And so that's a huge factor. Where that would happen or what price of oil, I really don't know, because it would vary mine to mine to mine. It would vary, there would be other variables, but the primary one would be what the costs are. The additional part of that, which most people don't know, is that a mine that is uneconomic, in other words, let's just do a thought experiment and say that oil goes to $200 per barrel and it stays there for 6 months as a thought experiment. Some of these mines would be mining uneconomically. In other words, they'd be losing money month after month after month. But believe it or not, many of those mines would stay in operation, as uneconomic as that would be, for the following reason. It's actually cheaper from a long-term perspective to run a mine at a loss for months. Again, it would be a case-by-case basis, than to shut the mine down. Now, why is that? And the reason is that there's so many costs incurred in shutting the mine down, as far as laying off people, mothballing the mine, getting rid of the equipment, undoing some infrastructure. There's just huge, huge costs involved if you shut down a mining project. So I've seen this from my experience. I've been in this, segment of the industry, mining metals and money, for so long that I question that initially. It's like, well, if you're losing money, why don't you just, turn off the lights? Another thing, it depends on the jurisdiction, of course, is there's huge repercussions if you lay off workers. In other words, they have contracts that are so tight that you have to pay them, 6 months severance or 3 months severance or something like that. Again, a case-by-case basis, where it's, again, better to kind of wait it out and grind it out, even though you're losing money. Having said all of that, I'd sum up by saying that if that were to occur, these mines that are thinking that they should stay open and wait it out and see what happens to the price of oil will minimize their production. In other words, they'll do everything possible to minimize the amount of metal coming out of the mine, in most cases, so that they can, have a bare bones operation and that type of thing.
Okay, well, let's switch gears a little bit and talk a little bit about manipulation of silver. In probably the most recent example, as you kind of alluded to already, on February 29th, we saw silver breaking out past $37, and just about as that happened, Ron Paul appears before Bernanke and pulls out an ounce of silver on national TV, and we saw over the next 30 minutes 225 million ounces of paper silver just absolutely dumped on the market. So I guess, do you think this had more to do with silver breaking out past resistance, or more of the symbolism of Ron Paul informing the American people about the wealth preservation of silver?